everyone. The presentation is coming up, but thank you so much for coming today and having us here. I'm really excited to see this audience, and I believe I heard this is like the 142. It's amazing to hear that this has been happening for more than a decade now and consistently, which is very impressive, and to many more decades to come. And I believe hopefully this room should be smaller by then, and you need to do it in a bigger room going forward. So, I think Mr. Prasanna spoke about routine. So I know we all know that there are more than 50 fund houses now, and we believe that we are not here to add one more fund house to your routine and try to do something different here. So let me try and give you some background about us first, and before I come to what we are trying to do. So before I start talking about AlphaGrep, I can tell you one thing. We actually believe that we are more like a technology company which is entering mutual funds, rather than saying that we are another asset management company. And you'll get a sense of why I am saying that we are another technology company. So AlphaGrep as a company is 16 years old. As a company, we run two businesses today. One where we manage our own capital. Where we manage our own capital is also a business. It's called prop investments or prop trading. This is something that we've been doing for 16 years. It's only 4 years back that we started managing outside money. But everything that we do for outside money, the capability we are leveraging from our own business, where we've been managing our money for 16 years. So let me give you some background of that first. So this business was started 16 years back by two of my colleagues, Mohit Mutreja, Prashant Mittal. Both of them come from a very similar academic and experience background. So both of them are Wharton pass outs. After passing out, they have worked with some very, very large global funds in the model-based, quant-based, algo-based trading space. Funds like Citadel, AQRD, Shaw. Got the experience, exposure, decided to come to India, started AlphaGrep in 2010. When they started AlphaGrep in 2010, they started with a relatively smaller base of capital. When I say relatively smaller base, they started with a capital of around 2 to 3 crores in 2010. Let's kind of fast forward to where we are today. So today, AlphaGrep has grown to being amongst the top 3 domestic prop trading firms in India. So whichever companies manage their own money in India, in that business, we are amongst the top 3. Today, our own capital from 2-3 crores in 16 years has now grown to 4,000 crores. So we deploy our own 4,000 crores in India and global markets. Another thing I can proudly tell you that unlike most other companies where we see multinationals coming to India, in our case it's the reverse. We are a homegrown company, but now a multinational. So today we have a presence in 8 countries around the world. We are connected to 30 exchanges around the world. So like we have 3 exchanges in India, BSE, NSE and MCX. Similarly, we are connected to 27 exchanges around the world. So we are connected to 30 exchanges. We pretty much trade all the traditional asset classes. So whether it's equities, commodities, currencies, debt, we trade everything in India, outside India. Okay. Now, our asset is largely, our people and our technology. So let me talk a little more about our people and technology. So we have today more than 500 employees in the group, which are present across these 8 countries. These 500 employees are broadly split into 3 parts. So we have around 250 people who we call quantitative researchers. In very simple terms, we have a 250 member investment team. So the number of people who come up with strategies for us or who build strategies for us, that number is 250. We have a separate 150 member team which only manages the technology infra of the company. So that's separately 150. Now let me just give you some sense of the pedigree of the people, like what kind of talent do we have. So out of 500 employees, around 450 of them are engineers. Okay. And again, like I said, we like to call ourselves a technology company, so you can very clearly see that we have 450 engineers in the company. Out of those 450 engineers, broadly, if they have done engineering from an institute in India, then around 225 to 250 of them will be from the top 4 IITs in India. Okay, so many of them come from IIT Madras. In fact, let me give you one more connection that we have with IIT Madras here. So, considering we are a technology company, we are one of the early adopters of AI, naturally, right? AI is making headlines every day. And as part of our CSR effort, as a company, we have sponsored 2 AI labs. One of them happens to be in IIT Madras. The second one is in IIIT Hyderabad, where we made a large donation in both these institutes to help the students and the faculty do research on AI in both these institutes. So I'm just giving you another connection with, technology for us and to Chennai for that matter. In terms of geographical split of our people, around 2/3 of our employees sit in India. So we have almost 150 people in Mumbai. We have a similar number in Bangalore. We have almost 40-45 people in Gurgaon. A small office in GIFT City. So that's in India. We have more than 150 people sitting outside India. So outside India, we have larger offices, larger meaning 35 to 40 member each in Shanghai, Singapore and London. And then we have smaller offices in places like Chicago, Dubai, couple of places in Europe. So that's largely how our, proprietary business is structured. Around 4 years back, what the founders realized is that whatever we built so far, whether it's technology, whether it's, research, whether it's strategies, whether it's people, we can extend this to outside money also. Why use it only for our own money? That's the reason 4 years back they decided to get into asset management or managing outside money. So 4 years back we set up 3 business verticals for asset management. One in UK, second in China, third is in India. Across the 3, as of today we manage around 15,000 crores of outside capital. So as of today, as a company we manage 4,000 crores of our own money and 15,000 crores of outside capital. So we have around 20,000 crores of total AUM that we manage as of today. Everything that we've been managing the last 4 years was largely institutional capital or family offices or HNIs. So even in India, in the last 4 years, we've been managing SEBI regulated products. So we have AIFs, we have PMS, we have a GIFT City based AIF. So all of this is not new for us. We've been already doing it for 4 years. But yes, mutual fund license is new. So this is AlphaGrep's first foray into retail. So far in 16 years, what we have done is that we built institutional grade infra, people, research capabilities. First built it for ourselves, then offered it to institutions, and now we are offering it for retail. Okay. Now, I just want to make a couple of points like why should one look at a strategy in the quantitative space. And many of us in the last few years have come across a lot of quant funds, a lot of fund houses have launched those funds. So, I can answer some of those questions later, but let me just give you some context here. Everybody's heard of passive funds, right? Index funds, passive funds. I'm just giving you some anecdotal evidence of US. And the reason I'm talking about US is because ultimately, whatever trends happen in US, India follows with some lag. So let me give you some numbers here. In US, 30 years back, broadly, total passive AUM out of the overall mutual fund industry AUM was less than 5%, which 20 years back grew to around 18-19%, and today it is 55%. Okay. The second largest category in US after passive funds is something called active quant. These are active funds, but these are fund houses that run strategies which are active but use a lot of technology or use a lot of models. So that is the second largest category today. Basis multiple different reports, that is around 20% of the industry AUM out there. And the category which has been losing AUM year on year in US for the last 5 years is pure active strategies, where for the last 5 years, every year they've been losing AUM, and active quant funds or ETFs have been getting flows year on year. For example, last year in US, only last year alone, ETFs and active quant funds got $1 trillion of net inflow, whereas active funds, which are funds managed by fund managers, lost $250 billion of AUM in US. And that's not 1 year number, that's for the last 5 years trend consecutively. Obviously numbers are different year on year, but that's a trend which has been happening for the last 5 years. Again, if you ask us the reason, this is only an outcome, right? Like AUM going in, going out is an outcome. why is it happening is a question we have to ask. Okay. And I try to generally ask this question to people that, do we all believe that sentiments drive stock prices? Does anybody believe sentiments don't drive stock prices? Does anybody believe that sentiments don't move stock prices? Everybody believes that sentiments move stock prices? Okay. Do you think flows drive stock prices? Like where money moves, like institutional flow, retail flow, FPI flow, does that move stock prices? Okay. Now, we generally believe that we should be doing investments using fundamentals, correct? That's what we've been doing for a number of years. And in fundamentals, if I'm not getting it wrong, we look at P&L of a company, balance sheet of a company, and annual report. Largely, these are three things that we can look at in fundamentals of a company, right? Now, if any one person can tell me where can I find sentiment and flow data in these three documents? Can we find this? Now, on one side, we are saying stock prices are getting impacted. I'm not saying 100%, but are getting impacted by sentiment and flows. On the other side, we are saying that we are only looking at fundamentals in investing. Then are we believing that we are looking at half information in investing in the markets? Now, the reason I'm mentioning this is because let's say 10, 15, 20 years back, also sentiments used to move stocks. But at that point of time, one could not capture sentiment in terms of data. Today, it is possible to capture sentiment in terms of data. Today, there is so much data which is available out there, which can be captured, which can be used. And that is where people who are able to use that data, capture that using technology, are having an edge. Let me give you another example. I don't know, I'm sure some of you all were in the industry even 20 years back when Fidelity had entered India for mutual funds. Do you all remember? Right? It was probably around 20 years back. And if I'm not wrong, when Fidelity came to India for the first time as a mutual fund, their whole pitch was that we are the largest money manager in the world. Correct me if I'm wrong. That we are the largest mutual fund in the world and we are entering India. Correct? Today, are they the largest mutual fund in the world? And Fidelity was known for having star fund managers. There were star fund managers which people used to know from Fidelity. Today, the largest money manager in the world are players like BlackRock, Vanguard, which are way larger than Fidelity. How many of us have heard star fund managers from BlackRock and Vanguard? Do we know any single star fund manager? Again, I'm just saying that these are funds which manage the highest AUMs in the world. Okay, BlackRock manages $13 trillion, Vanguard manages $11 trillion, which is way larger than our GDP. And they don't have any star fund managers. Most of the money that they run is using active quant strategies. A combination of either passives or active quant. Okay, so net, the difference here is that whether we want it or not, in future, whoever is able to harness technology and use technology effectively and combine humans with technology to capture this data, trends and everything will have an edge because data is not going anywhere. Let me just give you another example, last example, before I talk about, our fund or something like that. How many of you all have heard of Claude, AI tool? Everybody's heard? Which is the company which built Claude? Anthropic. How old is Anthropic as a company? 4 years. 4 years. How many people does Anthropic employ? Broadly, around 5,000. 4-year-old company, 5,000 employees. Forget what they do the IPO at, but last that they raised money from the market, they raised at a valuation of $960 billion. Okay, the reason I'm mentioning this number, now let's compare to our technology companies. We also have technology companies. Our IT companies are technology companies only, no? Anthropic is a technology company. Let's compare it to our technology companies. Let's take our top 5 IT companies as one bunch. How many years old? 30 years? How many people do they employ? Cumulatively? Around 15 lakhs, so 1.5 million. Right? So all these 5 companies together, 30 years old, employ 15 lakh people. These 5 companies together, valuation today is less than $200-250 billion. Together. Can you imagine a 4-year-old company with 5,000 employees, also in the technology business? Nothing stops our technology companies to compete with them. Na? We have been also making money for the last 30 years, year on year. They're all profitable, hugely profitable. They have huge cash reserves also. So ऐसा कुछ नहीं है what Anthropic could have done that we couldn't have done. There's nothing. But today the fact is that one company built something on technology today is valued at almost 5 times of our top 5 IT companies cumulatively together and what we have built in 30 years. That is how quickly technology is changing things. So whether we accept it or not, technology is coming and is changing things that we do in our day-to-day life. And that's a fact. Okay. So now that I've spoken about a lot of these things, so let me now tell you, what are we trying to do, using technology and where are we trying to use our expertise. So before I talk about what we are trying to do out here, the data that you see on the screen, I'm sure most of you all have some exposure to multi-asset funds, right? The data that I'm showing on the screen is not our data, is existing multi-asset fund industry exposure data. So we have taken the entire industry together and we are showing you that out of 100 rupees, how much is exposed to equity, how much is exposed to debt and balance. Now, this data tells me 2 things. I don't know about you, but it tells me 2 things. One is that most of my money is sitting in equity. Broadly around 60% of my money is sitting in equity. And the second thing it tells me is that exposure is largely constant, plus minus 5%, but that exposure is largely constant. Now one question I want to ask you, was the market the same in the last 5 years? It was not, right? So market was not the same. In fact, let me ask you another question, like if India were to play the next match, let's say, here in Chennai, in MH Indambaram, and let's say after that, the next game is going to be, let's say, in MCG in Australia, and the one after that in Eden Gardens in, sorry, not in Eden Gardens, in England, in Lords, will they play the same team? Will India play the same team, like the same number of bowlers, same number of batsmen, the same 11, the same number of all-rounders, or will they have a different team? What will it be based on? Conditions, right? Pitch conditions, climate conditions, multiple things. Now, at least what we believe is that if the conditions in our markets are dynamic and things are changing, then why should our portfolios be static? Let me show you some data here. So the data that you see on the screen here is for the last 20 years. I don't know how clear it is, but I think it is. Now, this 20 years, we have broken into 12 economic cycles. Okay, so 12 economic cycles meaning short economic cycles. So let's say 2008-9 was one such cycle, global financial crisis. Then you had 2011, you had the Eurozone crisis. Then 13 to 16, you had the taper tantrum in the US. Then 18-19, you had IL&FS crisis. So similarly, there are 12 such economic cycles that we have broken it down into. And what we have checked is that in each one of these economic cycles, which asset class did the best. So we have compared equity in green, yellow is gold, blue is debt. Okay. Now tell me something, in how many cycles has equity been the winner? Based on this, 6. So 6 out of 12 times, which means 50% of the times, equity has been a winner, and the balance 50% times, sir? Gold. Balance 50% of the times, gold has done better or commodities has done better. Now, imagine we are betting on one asset class to do the job for us because we are having maximum exposure to equity, which has only performed 50% of the times. The balance 50% time something else is doing well, which means that the balance 50% time we have a huge opportunity loss. It's like saying that in the last 2 years we were sitting in equity, but there was something else which was making money in the market. Had you taken some money out of equity and moved into gold, silver, would you be better off today, yes or no? Okay, so that is another fact. And the other thing which is also visible in this data is that whenever there is a sharp correction or some kind of a crisis, it's equity which goes through a sharp drawdown. There is no other asset class which is having that kind of a drawdown like equity. So one is we are having an opportunity loss in 50% of the times by sitting in equity, And the other thing is that when there is a drawdown, we are also going through that drawdown and taking that big loss when we could be sitting somewhere else and maybe even making money. So the reason I'm mentioning this is that most of the time now, we'll end up spending time on, you know what? We have pre-decided that equity is the best asset class. Let me spend my maximum time on deciding the number one fund or choosing the number one fund. Imagine in 2008, equity markets were down 60%. If you had chosen the number one fund versus number two fund, maybe instead of 60%, you would have lost 56%. So your return differential would have been 3 to 4%. But imagine at that point of time, that same year, if you had moved some money into debt, gilt funds made 25% that year. Gilt funds made 25% the same year when equity was down 60%. The difference between the two is almost the entire 100% of the portfolio. Okay? So I'm just giving you an example that, we believe that we need to, first think of one level above, where before choosing, saying that within equity I want to choose the right funds, can't we first decide how much to allocate where? And we believe that itself can do wonders in terms of risk-adjusted returns. So we will come to some of the numbers here, but let me just tell you what we are trying to do out here. And this is no different as a philosophy to what we do on prop in our own money. So as a philosophy, this is something that we've been doing for a number of years in India, outside India. That is exactly what we are trying to follow out here. So first of all, in terms of flexibility. In our case, the flexibility that we have given ourselves is, in equities, we can go down to as low as 10%. We can go to as high as 60%. We can do the same thing in fixed income. And in commodities, we can do 10% to 40%. Which means that, first of all, we are giving all three asset classes almost equal opportunity to participate, based on what the data or the model tells us. Now, the second point is on models. Generally, what we have seen in the industry, multi-asset, we could be wrong or I could be wrong, we have found two kinds of funds. One, majority of the funds, almost 80% of the industry are funds where the asset allocation is static. It is pre-decided out of 100, 60, 65 is equity, 20, 25 is debt, balance token exposure to gold, silver of 10, 12%. That's 80% of the industry. There's a small percentage which does dynamic. Okay. Now within dynamic, again, what we have seen, like I said, I could be wrong, but at least some of the products I have seen, is that they follow a valuation-based approach. Now what is valuation-based approach? For example, let's say some of the presentations I've seen is they look at equity valuations, like P ratio, price to book. Now, I'm just asking one simple question. By looking at the equity P ratio or price to book, how do I know how much to put in gold, silver? Or how much to put in debt? I have three asset classes in the fund. I'm looking at one asset class valuations and deciding how much to put in the entire fund. So again, in our case, because we follow more statistical models, the models that we deploy out here, so both risk parity and sharp optimization, both these as a starting point are not valuation-based approaches. These are pure statistical approaches, and within statistical approaches, what we call them are cross-asset models. Cross-asset meaning they look at all three asset classes as one package, not independent packages or independent allocations. Only then can I decide at the fund level how much I want to put. If I don't compare the risk of all three, or if I don't compare the risk-adjusted returns of all three, how do I compare? How can I look at one and decide how much to put in the others? Right? So that's what we do out here. So this is again, like I said, a statistical based measure. The last thing I want to mention on this slide is that a lot of people, tell us that we do monthly rebalancing. Now, again, another example. Let's say, for example, in March, when the war broke out, I think it happened, let's say, somewhere towards the middle of the month. Okay. Now, middle of the month, there is a war which has broken out. I will say that war is broken out on 15th. But my rebalancing frequency is end of the month. I will wait for another 15 days to do something. Because I have pre-decided I will do only something once in a month. And when we look at statistics, we ask ourselves a question, where did that 1 month come from? What is the logic of 1 month? Who decided 1 month? Why should we act on something only once in a month or once in a quarter? There has to be a logic. Because when we look at numbers, we look at everything, we look at numbers by logic, by statistics. So until something is proven or is kind of helping us from a statistical point of view, we don't go by a random number here. So in our case, the entire rebalancing frequency is on a weekly basis. So on a weekly basis, we can readjust our asset allocation between equities, commodities, and fixed income. So that's the last point I want to mention on this slide. Now once, let's say, the model decides on how much to put in equities, how much to put in debt, how much to put in commodities, within equities, we have a separate engine or a separate model which helps us decide on what stocks to buy or what stocks to sell. There, again, we don't have any style bias. Now, what do I mean by style bias? We have no bias to saying that I will only buy growth, I will buy only value, I will buy only quality, I will only buy small cap, I will only buy mid cap, none of that. This is a multi-factor model that we have, which can go across all styles, and we are not biased or not fixated on any one of them. Okay, so that's the other thing. And the last point I want to mention on equities is that we don't look at only traditional data. We marry traditional data. When I say traditional data, it's fundamental data, technical data, with alternative data. So we have sentiment, we have flow, we have derivatives data. All of that is part of the model. And again, coming to commodities, we are not restricted to only gold, silver. Like I said, at a group level, we pretty much trade most commodities around the world in India. So in this model, as a starting point, we are going to be allocating to gold, silver, copper, and crude, all four commodities. Another thing many of us don't realize is that, I was talking to somebody just outside, and we were discussing that in AIFs today in India, you can invest 1 crore. Correct? Minimum amount is 1 crore. In GIFT City, in an AIF, what's the minimum amount? $150,000. When the AIF regulations came in GIFT City, the reason they decided $150,000 is because they wanted to equate it to 1 crore. They had kept $150,000 because at that point of time, rupee dollar rate was such that it was equal to 1 crore. Today, can you imagine that has become 1.5 crores? The amount has not changed, but rupee has lost almost 33% value. In the time GIFT City has come, and now it's been hardly 5 years. And both equity and fixed income don't have any hedge against rupee depreciation. So any money that we put in equities, any money that we put in fixed income is not giving us any hedge. All the phones that we use, all the laptops that we use are all coming in dollars. We are not spending in rupees. We are earning in rupees, but we are spending in dollars. That's the fact. Okay. So commodity is the only asset class which can give us some hedge against currency, because all commodities are priced in dollar. Okay, let me tell you what we do out here. So I'm being cognizant of time as well. So this is our last 20-year, backtest simulation. For our practical purposes, we run these models live on our books. So for us, it's not a new model. We've been running these models for a number of years. If we had run this model over the last 20 years, this is our year-on-year asset allocation to equity, commodities, and debt. And as you can see on the table out there, our 20-year average exposure to equity is 28.5%, which is almost 50% of what you generally see in MAFs. And our average commodity exposure is 26%, which is almost double of what you generally see in MAFs. And balance 45% has been in debt. Now, anybody looking at this number generally tells us that you're running a very conservative product. You will not be generating competitive returns. So before we come to our returns, which is in column 4, I will just tell you, let's look at if we had invested 100% of our money in equity markets in the last 20 years, which is Nifty, which is the top 50 companies in India. In the last 20 years, we would have made a compounded return of 11%. Now, generally what happens is that we only look at the headline, which is return, we ignore risk. Now, to make this 11% return, how much risk did we take? The volatility of Nifty in this 20-year period has been annualized around 20%. And the highest loss we would have seen in Nifty in this 20-year period would have been 60% in the worst scenario. 60%. And there are multiple 1 year, 2 year, 3 year periods when Nifty is given a negative return. So this is Nifty. Now, if somebody had done static asset allocation, static meaning out of 100 rupees, 60 in equity, 25 in debt, 15 in gold, that would have generated a 9.5% CAGR with a volatility of 12.5% and max drawdown of 40%. And what you see on column 4 is our performance over the last 20-year period, 14% CAGR. But look at what is happening to risk. 7.5% volatility, which is 1/3 of Nifty, and 13% drawdown, which is less than 1/4 of Nifty. So very simply put, by just dynamically asset allocating at the right time to enter the right asset class at the right time, you are able to achieve equity-like returns with 1/4 the risk. It's as simple as that. And that's exactly the reason why we actually like to say that we are trying to build a journey out here for investors, which will look more like an expressway instead of taking a journey, where you have roads with potholes, speed breakers, everything, which our investors are taking using Nifty. So great. I will end my presentation here. I know I've taken the stipulated time. So thank you so much for that. If there are any questions, then we'll take it. 1 or 2 questions? Sure. No. So the positioning wise, we are not saying that I am trying to generate equity plus returns. In fact, what we are saying is that if a client of yours has a horizon of more than 3 years, 80% of the times in the past, we have generated returns between 12 to 14% CAGR with 1/3 or 1/4 the risk of equity markets. So what we are simply saying is that in the long term, if somebody puts money for more than 3 years, you are getting equity-like returns or equity plus maybe 100-200 basis point returns. So large cap fund returns, but not taking the 100% of risk of equities, but taking 1/4 the risk of equities. I am saying that in 10 years, if I am still getting the same returns as equities, or maybe slightly better, but with a much smoother ride, right? Then why would I not choose this? I'm not losing out on anything, right? Even if I have a 10-year horizon. I'm not losing out on anything. I'm only getting better risk-adjusted returns. Mid and small cap, yes, possible. So I'm saying, okay, so I am saying that I am not comparing this to a pure mid-small fund. I am saying that you compare this to a large cap fund. I'm not saying you compare this to a flexi cap. You compare this to a large cap fund. Large cap funds let's say in the last 20 years would have given like equity or maybe 100 basis point more than Nifty. We've also given that much with 1/3 the risk. It's as simple as that. So if somebody is happy with, let's say, FD plus certain returns and wants some stability to the portfolio, and to the questions that you ask at, markets are not going up in 2 years, markets are going down, what will happen to the markets, are the markets cheap, gold has doubled, silver has tripled, what should I do? And the beauty is that because all of this is happening within the fund, we can do as much rebalancing, asset allocation, everything, and pay no tax. Currently, we would be around 31-32% equities, around 21% to commodities. Half of that is in gold, balance 1/3 to the 3 commodities, and the balance is in fixed income. Very, very relevant question, ma'am. I will answer the cost part. So 2 things here. One is the total expense ratio that is applicable to us is the same which is applicable to any other hybrid multi-asset fund. So that doesn't change because that is SEBI defined. Now the base expense ratio that we have or any other multi-asset fund is the same. So that can't change. So the same cap is applicable to us. I'll just mention one more point here. Ma'am, tell me something. If a client of yours comes to you, takes all your advice to invest in a mutual fund, you will make them invest in regular plan or a direct plan? Regular plan, right? Correct? They're taking your time. But he or she, if they take their own decision of which fund to invest in, where will they invest? Direct or regular? Direct, right? Will direct be cheaper for them compared to regular? Same way, I am a client for a broker, right? As a mutual fund, I am a client for a broker. I am a DIY client for a broker. Do it yourself. I don't ask them for service. I don't ask them for research. I don't ask them for access. There's a reason. Very recently, SEBI has capped brokerage for mutual funds at 6. All that is available with us. So I'm not going to be trading 6 times off as normal mutual fund for sure. So SEBI allows you to invest in ETCDs, which is exchange traded derivative contracts. So on MCX, whatever commodities are available, except agri. Mutual funds are allowed to invest in using futures. So not only these, I can also do natural gas, I can do aluminium, but we have chosen these 4 because these 4 are the most liquid on MCX, and that's the reason we have chosen by liquidity. But we can do all 4. Gold, silver, also we can do futures, plus we can do ETFs. Sorry. Thank you so much.
I just want to say something. So thank you very much for listening to us, giving your time and attention. It's a huge gathering and we really appreciate your time over here today. Bhautik has talked about the product. What I would like to say is that we are here for the empanelment also. We've set up a desk outside. My colleague Gokul, he is based out of Chennai. We all 3 are here for some more time. We are happy to take your questions outside the hall also later during the evening. But along with the empanelment, once you complete the empanelment, as a technology firm, what we have additionally done is prior to launching the fund, what we did was we worked on an AI tool which has been made specifically for our MFD community, wherein what we have identified is that most of the MFDs want to adopt technology in their day-to-day lives, elevate their experience with the investors, but they don't know how to do it. So what we have done is we have created an AI tool which helps you. It's built on ChatGPT. It is coming to you for free. What it helps you with is, for example, just one scenario I'll talk about, and then you can possibly speak to us later during the evening. So when first time you get a client coming to you, who's a new client you are acquiring, what do? First thing that is required to be done is risk profiling, right? How do? Do you have a standard set of questionnaire that you give to every second client that comes to your office, right? But do you really think that standard questionnaire applies to everyone? Right? It varies because the client who's walking into your office is coming from a different income slab, has a different age group, right? Different demographic and different goals altogether, right? So his risk appetite can be different. So the questionnaire has to be very, very different for every client that is walking in. So what we have done, we have given you a prompt where you have to fill in the details of the person who's walking into your office, saying that I want to build a risk profile for a person who's drawing a salary of 25,000 rupees, who is 35 years old of age, and his goal is to get an X amount after 10 years, right? So this kind of a prompt we have given you as a cheat sheet for 10 such scenarios, risk profiling being the first one. You just have to type it out, copy it on this tool, and it will generate a questionnaire for you, which you can copy paste in your mailbox and send it out to the client. What will happen? You will get the right set of information from the client. You will be able to do the right risk profiling. Then the next step starts. What should you suggest as a fund? So there is another prompt that suggests to you as to how should you suggest the right fund. How do you compare different funds for the clients? Right? Again, it gives you a comparison basis what you upload. So we are not suggesting to you what you need to do, which fund to select from. That is your selection, what you want to propose to the client. You will upload the SIDs or the fund comparison that you want to run on this tool. It will again give you a comparison table, which you can copy paste and send it to the client. So what we have realized is that you all want to adopt technology, but you possibly don't know where to start from and how to give a prompt on these AI tools. So this is one thing that we have done. There are 10 such scenarios. Soon after you get empaneled, another 4 working days, you get a mail in your mailbox, which has a ChatGPT link. It is completely running on your login. We have got nothing to do. We are not storing any data on this. It's purely for you to use in your daily life and elevate the experience of your investors when they are coming to you, right? That's the first set of technological tool that we have introduced for MFDs. We are actually working on an advanced version also, which is currently just 2 months away from the live deployment. So we'll talk about it in future, but to start with, I think you'll find this to be a very useful tool. So thank you very much.
Thank you. Thanks a lot for taking time actually. And let me invite Mrs. Radha Hariharan to give a token of motto for Mr. Ambani. Thank you, sir. Thanks for taking time. And please give him a big round of applause. Thank you. Thanks.